In this video, I'm going to show you how to take advantage of the S&P 500, specifically with morning opening range breakouts. I'll show you two different setups. The first setup revolves around taking advantage of the actual breakout. This is if you're watching the markets early in the morning. The second setup that I'll talk about involves taking advantage of the reversal after this ORB trade has hit its target. This is if you've missed the morning trades, it's a way to still capitalize on the volatility that exists, which very much existed inside of the S&P today. Let's go through both setups, starting first with the opening range breakout setup. Now I'm going to discuss the 30-minute breakout here because I think that's the most prominent one. The 30-minute opening range breakout is quite simple in terms of a setup. We take the first 30 minutes of price action, so that's 6:30 a.m. to 7 a.m. Pacific Standard Time, since I'm in Pacific Time, so first 30 minutes after the market's opened, and we mark the high and the low of this period. If we break above this line, that's a bullish breakout. If we break below this line, that's a bearish breakout. And I'm looking for this breakout to take place really in the next 30-minute period after that first 30 minutes is formed. So really 7 to 7:30 a.m. Pacific. Now inside of the S&P 500, if we take a look, you had these candles right here, which had just wicks below the actual opening range breakout low, which triggered the ORB setups, but the S&P more decisively broke below this level shortly after the 7:30 mark. Now the setup is quite simple. When we cross below our opening range breakout low, which happens here, that's what triggers us into the short. And after the short got triggered, you'll see the S&P pulled right back to its market pulse line. We continued to keep drifting down lower, and each time price kept pushing down, you'll see buyers try to defend price all the way up until this breakout period ends. So if you are a morning trader, you are in front of your screens, as soon as this happens right here, you know that the ORB setup has now triggered. Our scanner even found SPY in terms of active setups. You're looking for any opportunities to try and get short, given that the S&P has a positive win rate in terms of ORB setups. Now we keep coming forward, and you'll see, or at least if you're watching the markets, you know exactly what happened. The S&P just continued to keep selling off, and we had one of those meltdown sort of days. So if we keep seeing where the S&P sells off to, usually you're left wondering, where do you either A, take profits if you are in this trade, or B, take advantage for looking for a long side entry. Where should you buy if you missed either this short side trade or you're a long side trader only? Where should you take advantage of this volatility and actually be looking at buy side entries? Now, to help us figure out where price action is going to stop, we can load in our volatility box models. And we have two different volatility box models. We have the aggressive volatility box models, and we have the conservative volatility box models. And these are both the daily models here. Now, I'll start with the aggressive first. Notice inside of the aggressive, this is our T2 line, and price in the S&P just keeps selling off. As we see the sell-off, notice what's printing. You should see these wedges here, and these are the Keltner channel wedges. I'll leave a link to download them. They're a completely free indicator. But what they tell us is price action is closing outside of the 3.0 Keltner channels inside of the S&P 500. So that means we should be expecting some sort of a reversion to the mean trade, but we need to see the selling exhaust. We need to see the selling stop. So price here broke straight below the aggressive models, and these wedges continue to keep printing. We're looking at this green arrow to help us figure out where the sell side activity should stop. And if I load in the conservative models, you should notice that that did a much better job of containing price action and volatility here. Inside of the S&P, we had our first little bounce here, and then we hit our conservative volatility box models as soon as price touches the clouds here. And this is the trade in the S&P. If you missed the morning and you're looking at trading the afternoon, this is after the lunchtime hour. This afternoon bounce is what you can take advantage of. It's still a way to capitalize on this overdone volatility, taking advantage of the S&P as it's inside of its conservative volatility box models for what I think is the closest thing to a no-brainer trade you might find. Let me show you the Qs as well. The Qs did not hit the conservative models until the end of the day. However, the Dow was a really nice trade because we went outside of the conservative models, and notice where we start to see our edge signals print and the rally that we see in the Dow compared to the rally that we see in the S&P. I would argue the Dow had a nicer trade in terms of a risk to reward, and it's the exact same setup, but here inside of the Dow, we've broken even outside of the conservative models, which is your very clear sign that, hey, you're getting a better price than you normally do inside of the Dow. So that was the case for both the S&P and the Dow. The NASDAQ was the one which only into the tail end of the markets breached the conservative volatility box models. The NASDAQ, you had to be a little bit more aggressive in terms of buying. So there you have it, two different setups to take advantage of volatile days like today. The first setup involved capitalizing on the opening range breakout setup. Very simple setup. We take the first 30 minutes, that's the 30-minute range here, and we draw the high and the low. If we break above the high, that's a bullish setup. If we break below the low, that's a bearish setup. Inside of the S&P, we broke below the low. That triggered us into the bearish setup, pulled back, chopped around a little bit, until we saw sell side activity hit T1, hit T2, and continue to keep going beyond this level. In terms of understanding where we were looking for the sell side activity to exhaust, that's where we loaded in our volatility box models, and the conservative models gave you a very clear price action along with the recognizable setup that we could take advantage of, both inside of the S&P and inside of the Dow. I hope you found this video helpful for those of you looking to trade the index markets through this volatility. Take care, everyone. Good luck trading, and I'll see you in our next update.